I'm Tennille.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. So for today's episode, we're joined by Mark Everingham from Personal Risk Professionals, otherwise known as PRP. So welcome, Mark. Thanks for joining us today.
Thanks, Kels. Yeah, PRP is much easier.
It is, yep. So we'll be referring to it as that throughout. And Mark's kindly come up from Brisbane, which is where they're formally based in their offices. And it would be really good to, I guess, lead into the conversations. Obviously, your bread and butter is insurance,
yes,
personal insurance. So tell us a little bit about yourself, Mark.
Sure. So I've been in financial services for 30 years and been advising for the last 25. So it's amazing how quickly time goes.
Mm-hmm.
I founded PRP 17 years ago. I guess I'm the unusual financial planner that is more passionate about insurance rather than investments and financial planning. So I think that's why this relationship between our firms works quite well. It's probably driven by my own personal experience of what I've seen happen in my own family, of why I've ventured down this part of the profession. When my father was 48, he had a significant cardiac event and couldn't work again. And I saw firsthand what uncertainty that created for our family, both financially, but because Dad wasn't really insured and didn't know anything about it. He was left sort of on his own to deal with the financial consequences of that, and that's flowed throughout our lives. So
Yeah, wow.
I guess there's a bit of a personal vendetta on making sure people don't go through the same process that we went through as a family. So, we're really passionate about making sure people are properly protected, and then especially when it comes to claim time, they've got someone in their corner that fights for them and gets the outcome that they've been paying a premium for all that time.
Yeah, and I think it's, I guess in a way it's wonderful to hear your story around how PRP was established, because like you were kind of saying, most people in the financial advice world, kind of when it comes to insurance, because it's such a niche field and so comprehensive that, to look after that for a client really well, and be across all the changes and all of the bits and pieces there, you do almost have to specialise, and people usually aren't too interested in it. So it's actually wonderful to know that there's people like you and the people that work at your firm too, that are truly passionate about personal insurance cover. And I hope today that we can kind of cover off and give some more information around, why is it so important to make sure that people have insurance in place, and some pointers and some tips. But
absolutely. I mean, people dabbling in a bit of insurance is as dangerous as me dabbling in a bit of investment advice. Like it is a highly complex, regulated, legalistic sort of area. So you do need to focus on that 100% to be really proficient at giving that advice. Especially when it's claim time as well and you're navigating the administrative field that you have to meet on that front. So, that's all we do day in, day out, 100% of our time. Yeah.
Now, Mark, you're Managing Director of PRP, and you've said you've been around for a while.
Yeah.
So tell us a little bit more about what's happening for your firm, because I know that you've had a bit of growth over the past few years and some very prestige awards.
Yes, yeah. I'm not a big self-promoter, but we were blessed enough to be named the inaugural PPS Mutual Life Risk Practice of the Year this year. So that's an amazing social proof point for the hard work that we've put together as a firm over the last 17 years.
Absolutely.
And the criteria of that was largely driven around client experience and client feedback. And it was flattering to see the feedback we got from our clients throughout that process. Look, as far as growth goes, the industry's changed so fundamentally over the last 5 to 10 years because of regulation, education requirements. That's led to a large exodus out of financial planning for a lot of businesses. So I've been a big believer that from an insurance point of view, we have to change the dial on not being a cottage business like we've traditionally been, where at the end of the day, the principal might grow the business, but when he retires or the business just dies with him or her, Now, our business is a B2B business. We are the subject matter experts for other financial planning businesses like Allman's, other accounting firms. So that can't just die with me when I retire.
Yeah.
So we've built a lot around succession in our business. We've got 2 younger partners as part of our business, Corey and Courtney. Corey's done one of your podcasts in the past.
He has, yeah. Make sure you check it out.
Yeah, so I've been blessed to have them as part of the business for the last 11 years, and they've invested their money in the business from that point of view. And year before last, we had a highly aligned national life insurance business, MBS Insurance, invest in us to help us with our growth in Queensland. So we've got that succession plan behind us. So the relationships we've formed over the last 17 years can continue on, irrespective of who's in the business at the time.
Yeah, which is wonderful to hear. And I think, the relationship is a big part of your business, right? This isn't about just, take out insurance and off you go.
No,
understanding your clients really well, forming those relationships and knowing it's for their lifetimes is what's important. Because I think there is a little bit of a misconception, and correct me if I'm wrong, that, some people go, oh yeah, get insurance, I've got it, and then I'm done with it. Yeah,
it's certainly, especially in the last few years, it's the last thing that you can just set and forget these days. I think there's 2 real common misconceptions about insurance. The first one is, I don't need to worry about it, I've got it in my super fund.
Yep, heard that one.
So, I mean, what's changed in that environment is the claims experience in group insurance in super has been horrendous over the last few years. So that's driven increasing pricing through those platforms. Some of the industry funds have gone up north of 40-50% in the last couple of years. So that's driven a need to look at that, but also the automatic acceptance limits and the amount of cover you get automatically has fallen. So people thinking they've got a lot of cover in their super fund, they might find out they've got 400 grand of life and TPD, maybe income protection, maybe not. If it does sit in there, it only goes for 2 years. So you line that up with the average mortgage that people have these days, it's never going to be enough in that circumstance. So that's a really important sort of point of review. I mean, the other misconception, which our good friends in the media unfortunately don't help us with, is insurers don't pay claims.
I think that's the big one, actually.
So good news stories don't really make the news. So, if there is an insurance story on the news, it's generally because a claim's been declined or whatever the case may be. But if you go to the Money Smart website, there is actually claims data that sits on there to show the claims rates, payments for life, TPD, trauma, income protection insurance. Life and income protection are north of 90%. TPD and trauma cover are in the high 80s of acceptance rates. So this myth that they don't pay claims is crazy. I've tracked all the claims that we've managed throughout my career since 2003, right through our business. We've managed $78 million of claims. This is a firm for about 280 something families, and I can count on one hand the number of declined claims that have occurred, and they're not because the insurer has been acting untoward. It's generally been because non-disclosure occurred. The medical history of that person just wasn't disclosed properly. They didn't meet policy definition. At the end of the day, there is a definition of what every event is. So that myth, I just don't cop it. It's just not right.
And I think those stats are excellent, and for people to be able to go and grab those, I think hopefully should give some confidence that if you get insurance and something happens to you, that you're highly, highly likely that you're going to receive that claim payout. So
what's interesting on that Money Smart site is it actually breaks down the success rate between using an advisor or through your super fund or going direct to the insurer. Going direct to the insurer is the lowest claim outcome rate compared to the other 2. And I firmly believe that's because there's no advocate involved in that process.
Absolutely. And that's a big part of what you guys do, right?
100%.
Supporting people with those claims.
If I go back to like my dad's situation, or you compare life insurance to home and contents insurance, if your house burns down, you're generally in a position where you can go to the insurer and deal with that. But if you're deceased or you're disabled, and you don't have someone acting for you, it's very hard to go and deal with that stuff directly, especially if it's a mental health claim or a cancer claim and you're going through something quite horrendous. You're probably not the headspace to manage it.
Absolutely.
And, you know, there is an administrative process you've got to go through to qualify for the claims. So that advocacy piece is the difference between those stats, 100%.
Absolutely. Well, for today's episode, we've covered off quite a bit there in itself. And, you know, we can really go down rabbit holes with insurance conversations, believe it or not.
I do get a little bit excited about this stuff.
No, this is great. And this is why we're here. And this is why we love having you here, because I know that you're really passionate about it. But for today's episode, what we really want to talk about is the pricing volatility. So there is this kind of what's happening at the moment, and what you're probably seeing, Mark, is that new clients are paying less than existing clients when they're taking out insurance. And it could be the same policy, like for like. And, you know, talking then about what are the benefits of actually reviewing your policy. So we're going to break it down. We've got 3 episodes coming. So we're going to solely dedicate this one to, you know, talking about the pricing volatility. But I guess I'll lead with the question for you, Mark, around, you know, when should someone start taking insurance seriously? Because a lot of people are put off by cost. So, you know, what is that kind of balance of going, I really should take this seriously now, and, you know, cost shouldn't be a factor because I need it.
Yeah, it's
loaded question.
It's that grown up. I'm a grown up now. So when do I need to start?
When does that happen?
Oh, I don't know. I'm 50 and I still feel like I'm 15. But the fundamental starting point would be when you start earning an income. So your biggest asset you have in life is your ability to generate income. So if we keep the maths simple, you know, if you're earning $100,000 a year and you work for 30 years, that's $3 million as an asset, not taking into account inflation or anything else, that is worth to you. So if you went and bought a home for $3 million, would you insure it? I think the answer would be naturally yes.
I hope so, yeah.
You know, you go buy a car for $50,000, do you go and insure it? So to have an asset that relies on you being able to get up and go to work every day, that's not insured, doesn't make a lot of sense. And I don't think people really put a value on what their future earning potential's worth.
Absolutely. So that's income protection. That's kind of like your starting blocks of personal insurance.
Yeah.
If you're just, you know, you're out working, perhaps you're still living with parents at this point in time, whatever it may be, as a minimum.
At a minimum, income protection should be on the table for you because... if you suddenly can't work, then you're either a financial burden to yourself or to your parents if you're living at home. So, you know, I think there's a bit of moral duty of care there to go, well, I can either rely on the government or my parents in that circumstance, or, you know, this can protect me for something that's otherwise tax deductible to you. You can make sure that you can continue your living and lifestyle needs without being a burden on someone else financially. At the start of your career. Obviously, the other advantage of starting early is you're young and you're healthy and it's easy to get insurance because you're not going to have a large raft of medical history behind you that might create baggage with the insurer.
So speaking to income protection in particular, is there a benefit in taking that out earlier rather than later?
Certainly from the health point of view, absolutely. There used to be quite an advantage of sort of using what's called level premium versus stepped premiums. So level premiums are you pay a higher premium today and the premium stays at the age you entered the policy. So you're effectively having long-term affordability occur in that circumstance versus stepped premiums, which is lower now and it gets more expensive as you age. Unfortunately, just with the claims experience over the last few years, that cutover point of when level premium outweighs stepped is now probably closer to 15, 20 years down the track. And they're not those rates aren't guaranteed. So if you go through that experience like we have over the last few years, level premiums have gone up like stepped premiums have. So the advantage, I suppose, in getting in young is stepped premiums are really cheap for people in their 20s. So it's not going to be a huge impost on you really now to get the cover you need. So at least you can keep putting food on the table and those sorts of things.
That's right.
If you can't work.
Yeah, and if you fund that, not for your super fund and you fund that personally, then you can also get a tax deduction for the premium that you pay. So there's a little bit of an incentive to do it as well. It's not going to be completely out of pocket expense.
No, exactly right.
Yeah. So how do you help your clients then determine what risks are worth actually insuring against and which they should or perhaps think about self-funding?
Yeah, sure. I think from a personal insurance point of view, there's really 3 pillars that we focus on in managing someone's financial uncertainties. Mm-hmm. The first one's debt. So how much debt do you hold? So if you pass away or you can't work, do we need to pay that off, or do we need to fund the repayments for periods of time? So it's understanding and quantifying what that risk is. Mm-hmm. If we've dealt with debt either from a repayment point of view or an elimination point of view, what level of ongoing income do you need to live off? Mm-hmm. Like, it's one thing to pay your mortgage off, but you then still need to eat and live and do those sorts of things. So, excuse me, so it's trying to understand, well, what are your living lifestyle needs and how do we replace those?
Yeah.
And then you've got contingency funding. So what other things do most people not plan for? For example, like if I got diagnosed with cancer, what are all those out-of-pocket expenses I'm going to be exposed to that I might not be saving for at the moment? Or if I am permanently incapacitated, what modifications might I need to my home? All of those sorts of things.
Absolutely.
So sort of taking them through that 3-pillar approach of quantifying what all those needs are and then helping them prioritise, well, you can cover them off using life insurance, total and permanent disability insurance, trauma insurance, income protection. Yeah. Here's how these things fit together and here's what it costs. Yeah. So usually the cost part then becomes let's have a chat about what we might self-insure if we want to manage costs, especially in the younger years. Yeah. Or when you've got kids and mortgages and all those other competing costs.
Yeah, which is really interesting because, we often see it as well where people say, well, let's just cover the bare minimum. And in the financial planning world, I guess in what we do is I always challenge them against their goals, because people are often saying, well, I'm going to have this event happen to me and then I'm willing to peel back my lifestyle.
Yeah,
and
exactly.
then also not continue to achieve all the other goals that I've been planning for because I can no longer afford it. So I think it's definitely the bigger picture thinking of, what else was you planning for?
Yeah.
You may still want to do and achieve. So
yeah, I mean, that's part of the beauty of our working relationship is you're setting a plan in place for the client to go, you're going on this journey and these are going to be the outcomes for these goals and objectives you want to achieve. Mm-hmm. So when you refer them across to us, we know what they are. Yeah. So when we're having a conversation with them, we're pretty much just lining up going, okay, out of all these goals and objectives that you've got, which one of these do you not want to achieve if something happens to you? Yeah. And usually the starting point is, well, we want to still achieve all of them. So we then do that contingency funding process.
And do you find that that's the case until they see the premium?
Absolutely. Like paying insurance premiums for pretty much everyone is that they just see it as a necessary evil, if that makes sense.
You're paying for something that you hope you never have to use.
Yeah, and look, for us, our most successful relationships we have with clients, and we've had this on a number of occasions, where I've had clients for 20 years that have paid premiums for 20 years. They've got to retirement. They've never claimed on it. Mm-hmm. And they retire in the fashion that they'd planned for. Yeah. Now, for us, that is a huge win because they haven't had to go through some horrific event in their life for us to then come in and manage a claim for them. Mm-hmm. On the other hand, the stuff we have put in place for them has been the thing that saved their plan when things didn't go according to the direction they wanted to go.
Absolutely. And sometimes it's just about having that peace of mind. Whether you've had to use it or not is irrelevant. You had the peace of mind along that journey.
Yeah. Just an interesting aside with that, Kels, is I had a client who was a business client. He sold his business for $32 million in cash. And we had a portfolio of insurance on him. And he rang me saying, do I need this insurance anymore? And I went, well, how long is it going to take you to spend the $32 million? And he said, well, me and the generations behind me won't be able to spend it. And I said, well, you can cancel your insurance. Still hasn't cancelled it. He's just,
Wow.
I think there's this sort of bit of superstition sometimes that if I cancel this thing, something bad's
going to
happen to me. So,
yeah.
you know, you can't bring a logic into it all the time.
No, that's very interesting. Oh, that's a great story. So what, Mike, what is it then that's happening as to why new clients, so people that are taking out new insurance policies, are paying more for like policies than people that already have it in place?
Yeah. So there's sort of four forces that have come together over the last few years that has forced insurers to change how they price cover. So essentially, if you're a new risk to the insurer, i.e. they underwrite you today, they know about your history right up to that point in time. So for them, you're a better risk to them than the policyholder that came in 10 years ago, and they have no idea what their health looked like over that last 10-year period of time. So when they've had significant claims experience, I think fundamentally the insurers are saying, look, because we get to have a look at you right now, we will discount you as a new policyholder because you're a fresh risk to our book versus someone where they've been in the pool for 10 years, and then, you know, because these policies are guaranteed renewable, the insurers are stuck with you irrespective of how you treat yourself post that period of time. So I think that's part of the reason they're managing that risk, and so they're discounting people into the pool, and then that discount will unwind over generally a 5-year period of time. So people will see that their premiums will grow over that period of time as that discount winds off.
Should people worry about that when they're taking out policies, though? I mean, is it a significant difference? If they're on a level premium, would they find that would be a significant difference in cost?
Yeah, I mean, the issue with level premium is the premium you pay to have that level component, you're generally 3 times the amount of stepped premium. So you're really taking a leap of faith in that circumstance that I'm going to hold that policy for long enough to benefit from, and then not be some sort of pricing event, which has happened, you know, probably 3 or 4 times over the last 10 years, especially. So I find it very hard in good faith to use level premium because it's not actually level premium. We actually can't even call it level premium anymore. It's called variable, and the stepped premium is called age-based variable. So if that tells you what it's worth,
if that's the case, then you go with the lower option.
You go with the lower option, and you manage the changing circumstances over the time the best you can.
Yeah. Interesting. Okay, so when should people, let's say someone's come to you, they've taken out their insurance cover, what's the trigger points then for them to come back and review that cover?
I mean, like any part of your financial affairs, like, you know, your wills and powers of attorney and those sorts of things, you really should check in on that stuff every 3 years anyway, just to go, what's changed in my world that might mean this is now out of date. So
because a 3-year period, I mean, that's long enough for you to maybe have reduced your home loan by quite a bit. You might have had a few pay rises since then, so it's enough time for things to have maybe not monumentally changed, but enough to trigger a
I did a review with someone this morning. The last review we did with them was in 2024, and they've had 2 kids in that period of time.
That changes things?
Changes things quite a fair bit, especially when they were unexpected twins, going from 2 to 4. So those sorts of things, you know, drive it. Significant life event changes then really should be the trigger points. So, you know, getting married, getting divorced, taking on home loans, getting pay rises, having kids starting private schools, anything that changes your income or your asset base really should be, you know, a trigger point for review. You know, for us as a firm, you know, we also then are looking at what's happening in the marketplace that might drive that, and that's, you know, this whole pricing structure change that's occurred over the last few years never used to be an issue. Like, if you entered a pool, you paid the same premium as someone else. So, but now we're finding, you know, clients who have got policies that are 5 years or older are potentially paying like 40% more than being a new entrant to either the same insurer or an alternate insurer. So the world's changed quite dramatically in that front. So it's the combination of what's changed in your world and what's changed in ours that drives it. So every 3 years having a check-in makes a lot of sense.
Yeah, absolutely. Do you find that people sometimes do come to you after something has happened and gone, I've had a health event, now I think I should review my cover? Now, how often do you see that?
Either a health event happening to them or someone close to them is what drives it, because there's always the Australian attitude of it's never going to happen to me. I went to a conference once, and one of the chief medical officers was speaking to a room of about 1,000 people, and they just were talking about the power of trauma insurance, and they got the whole room of people to stand up, and then they asked 2 questions. They said, if you know someone in your family or circle of friends that has been touched by cancer, please sit down. And then the second one was, if you know someone in your friends or family circle that has been touched by a heart attack, please sit down. Out of a room of like 1,000 people, there was about 4 or 6 people left standing up.
Powerful.
So, that is a driver for a lot of people. Yeah. And unfortunately, once the health event's happened, it's too late.
Yeah.
If you've had a cancer diagnosis, you're not insurable. So, getting insured while you're healthy is really important. On the same breath, there's a number of claims that we've managed have come out of review meetings where, we're doing a review with a client and we ask them about changes in their health. And I remember one was a doctor we were doing a review for, and I said, what's happened over the last 12 months? And she said, I had my thyroid removed. And I went, oh, that's interesting. Why was that? And I had cancer in my thyroid. So they removed it, I'm fine. Like, it's a pretty simple procedure to go through. And she was wanting to reduce her cover because the kids had left home. That turned out to be a trauma claim and an income protection claim. That, if she just didn't do that review with us as an advisor and she's made those calls herself, she's just paid years of premiums and missed out on a claim that she was owed because of what's occurred.
And that must happen often. I don't think people really fully understand the ins and outs, particularly if you don't have an advisor that's in your corner either. What are you actually insured for? And that must happen quite often, people, been off work for multiple reasons, having surgeries or whatever it may be, and there could have been an income protection claim, but they've kind of gone, I'll be all right.
Yeah.
I'm able to go back to work.
Yeah.
I'm fine.
Yeah. Yeah. I've got a couple of examples where one of the accounting firms we work with referred us one of their farming clients. Him and his wife were paying like combined like 80 grand in premium, like big sums insured of trauma insurance and life cover. As part of our review process, we get people to complete a medical disclosure just so we know what their health looks like before we even start giving them advice, because if they're really unhealthy, we're just going to be wasting their time or it's going to have implications on them. So this client wanted to save premium because of how much money they were paying. He had a quintuple bypass at Christmas time, typical farmer. I said, oh, is everything all right? He said, yeah, fine, I had surgery. And I said, you've got $400,000 of trauma insurance here. Did you claim on that? No, why would I claim on that? And so, the review meeting turned into a claim meeting, and we got his claim paid, and life just goes on for him. And and I had,
you must have so many stories like that. That must just happen all the time.
And people just don't know what is necessarily covered under their policies. Melanoma is a classic. Australia's the skin cancer capital of the world, but the grading of your melanoma is really what drives the claim outcomes. And so we've had 2 claims where clients had a melanoma removed. It just happened to come up in conversation, and it's like, you realise you're covered for that. And it's like, what do you mean? I just had this thing cut out and went back to work. That's what the policy covers.
Yeah, absolutely. So, it's really, really interesting. And sometimes you can actually have policies that appear the same on the surface, and people will go, oh, yep, they look the same. I'm going to go with the cheaper option. Yeah. So how do you really unpack what lives behind there?
Yeah, well, I mean, that's where your knowledge of the product really is important. So if I use the simple example of TPD, insurance total and permanent disability cover, that's the typical, I've got this in my super fund, you know, why would I look at another type of policy? So to sort of get a bit technical for a second, what's covered as far as TPD is concerned in super is what's called any occupation coverage. So it's not paying you until you're disabled to the point that you're unlikely to return to any occupation you're suited by way of education, training or experience. So if you've had a breadth of experience in your career, under that policy, the insurer is going to be looking for transferable skills that you could be doing in another role. And if you can do those, there's no claims to be paid. The more expensive version of TPD cover is own occupation, which you can't get in super, but it's insuring you to do the occupation you're employed in. So, you know, if you're, for example, a medical specialist and you can no longer be a surgeon, but you can go and be a GP, any occupation coverage is no good for you because you'll be working as a GP earning significantly less money than what you were earning before. But own occupation recognises your ability to do that job no longer, and it will pay out upon that, and then you can go and work somewhere else.
And you can take a drop in income, and it might actually work out okay if you had the right amount of cover.
Yeah. I mean, the claims experience on mental health has been pretty horrendous, but mental health claims on own occupation for, you know, high earning executives and those sorts of things, because stress is a big factor of those jobs. Being able to return to your role as a CEO is very different to a middle management role or something like that. So, you know, that definition difference can be the thing between getting paid or not.
Absolutely. And I think, you know, just in what you're saying, it's so apparent how complex the insurance world is that, you know, if you're out there looking for insurance cover and you haven't done your study in this field and you're not really across all these intricacies, it's very easy to get it wrong, or maybe not as comprehensive as you should have it. So for people that are kind of out there doing it themselves and they've gone, I've got this insurance in my super fund, I'm going to go and look for something myself, I'm going to replace it, et cetera, what are the biggest mistakes that you see people make when they're reviewing cover or cancelling cover and taking new cover?
Yeah. There's probably two key ones I see. So in 2021, there was a significant change in income protection in Australia. Prior to 2021, you could get what was called agreed valued income protection cover, which is really important if you're a business owner and you have fluctuating income. That effectively means that you provide your financial evidence to the insurer at application time and you agree on your sum insured, so when you go and claim, you know what you're going to get paid. That was very generous towards the insured, and claims experience really had driven some poor outcomes for the insurers. The regulator stepped in and said, no more agreed valued cover, everything now is indemnity, which means your income is going to be assessed on the 12 months leading up to claim and you get paid a benefit based on that. So fundamental difference in how you're protected. On top of that, income protection cover used to be own occupation through to the expiry of the policy at age 65 if you had that benefit period. Now it changes to any occupation after 2 years. So if you don't know this level of knowledge about the product change, you might look at an old policy and go, geez, that's expensive compared to what I can get now. But you're paying for something that's fundamentally different.
And very big difference in outcomes and the impact that it can have on your life if you don't get it right. So
100%.
It's almost like price should be just a byproduct of your decision-making process. In some ways. It's really not a factor. But that's hard, right? Because you must often get people saying, the cost of living, it's getting really difficult, and then trading the premium versus, having cash flow to live is a difficult situation to be in. But there is things you can do, right? It doesn't have to come from your cash flow to fund your premiums.
No. I mean, superannuation certainly has a place to play in terms of, owning and funding your insurance where it's appropriate.
There's always a trade-off, right? Because then you're taking away from future you too in doing so.
So it's really just going through in a process of going, what would I like to be covered for and what does it cost? Does that fit in my budget? If the answer to that is yes, then it should be a no-brainer to actually put that in place. If it doesn't, then it's just working through an informed process of going, well, what am I foregoing? Like, you know, am I happy that I'm not covered for my own occupation and I'm just covering if I can't do anything ever again? You know, do I just adjust the sum insured instead of having, you know, 200 grand of trauma insurance? I'm happy to self-fund 100 of that myself and lower the premium. It's just working through that exercise of, you know, balancing out the risk with the cost.
Yeah, absolutely. And when someone comes to an advisor for an insurance review, what are some of the good questions to be asking? Because, you know, not everybody is going to come to PRP.
No.
So, you know, what are the good questions that people
They should
be
but
asking?
but no. I think the questions to go through would be, you know, what cover types are available to me to protect me? So just start getting educated by the person sitting in front of you. You know, how much cover do I need? Like, it shouldn't be, I'll just pick a number out of the air and that's it. It should.
What's the methodology?
Yeah, what's the methodology on why this sum insured is the sum insured I'm being recommended? You know, what sort of things should I be looking for in a policy for my circumstances?
Yep.
You know, what's the best way to pay for my cover? You know, we talked a little bit before about super or non-super ownership. Yeah, that's a cash flow thing, but it also has tax consequences and who can get the money and those sorts of things. So you want to be testing the understanding of the advisor on what's the best way to pay and own for my cover. You know, how long do I need the cover for? And, you know, tell me about the quality of the insurer. What's your experience with them on managing claims and those sorts of things? So I think that's a good starting point to have a framework to walk into a meeting on, to go, how does this apply to me and what are the outcomes going to look like?
Yeah, and I like how you mentioned that education piece because, you know, we also think that that's so important because the more education that you can give to somebody, they're going to be more confident in their decision-making process.
Yeah.
And they're going to, you know, be able to make informed decisions and understand a little bit more about, you know, what they have and why they have it. And I would think that kind of goes a long way in making sure they keep that cover. Because you know, it can be a bit of buyer's remorse. I'm sure you've seen people that take cover out and they do it for a year or two and go, I haven't had to claim, let's just cancel.
Yeah, well, I mean, it's that methodology is really important. And it's interesting you raise that, Kelsey, because you look at the direct insurers on TV. You know, if you're unfortunate enough to have to watch daytime TV at all, you see the insurer ads. You know, you ring up and you get your insurance over the phone. There's a stat that's measured with insurers called lapse rate. It's what percentage of their portfolio cancel cover and when do they do it. The lapse rate at year one renewal with those direct insurers is significantly higher than advised clients. And the reason is the why behind why they've got the cover in the first place. Like, to buy something off the phone or from the TV, there is no advice process given about what's this level of cover for, what job's it going to do if I pass away. It has no meaning. So the only meaning it has is the amount of money coming out of their bank account. And when they get their renewal notice going, oh, that's right, I'm paying $100 a month for this insurance, it gets cancelled because it's just another bill like everything else.
Yeah.
Where, you know, if you go through this education process and apply that client's circumstances to that portfolio, it sticks much more deeply on, well, if something happens to me, I know what jobs this stuff does out the other side of that.
Absolutely.
And so, you know, our lapse rate is exceptionally low in comparison to any of that direct stuff.
Yeah, absolutely. And I think, you know, any relationship that's long-lived is the good ones, right?
Yeah.
So, and I think, definitely forming those relationships, giving that education and really knowing that you're dealing with an expert, because you really do need an expert in that field, is really what's going to give you that peace of mind. And I think that's what everybody's looking for, whether it's, you know, insurance advice or, you know, the comprehensive financial advice. That's the key aim goal, right?
Yeah.
So a lot of my clients are business owners, and I would really love to dive into understanding a little bit more about what you might say to somebody that's just started a business and, you know, cash flow, costs probably high alert, maybe not thinking about their own insurance at that point in time.
Yeah.
Is there any sort of, you know, red flags or key things to consider as somebody is going through that journey and through that process?
Yeah, I mean, you know, starting and running a business is one of the riskiest things you can do. It's very different to being an employee, and, you know, your paycheck's showing up every fortnight or month, and and there's a whole raft of protection from legislation around you with leave entitlements and those sorts of things. But when you're running a business, you're taking on risk for future financial gain, and it's not until long way down the track does that actually arrive. So the exposure you carry in those early years is exceptionally high because that future value of that income's just not shown up yet. So I find advising business clients is far more complex than advising personal clients because the income streams are known.
So really, they even more so need someone that they can
absolutely
have the support from.
Because so many people are relying on the business owner for their financial success. So, I've got 12 staff. Like, you want to make sure that if something happens to me, that's not me out of business and 12 people.
And the ripple effect of that, those 12 people, and all of your clients and et cetera, et cetera.
So, the biggest thing obviously in running a business is what your ongoing expenses are. So, if you've got leases to pay, staff to pay, all those sorts of things, making sure you've got coverage to cover that off in the form of business expense insurance.
I mean, we could probably do a whole podcast
I could do a whole.
So we'll tee that up.
I think that's probably worthwhile doing one specifically on business owners and especially multi-owner businesses or family businesses. Because they've got a whole range of specific risks that are very different to the family-related risks that comes with personal protection.
Absolutely. So, Mac, is there any particular insurance policy that people tend to forget about? And I think we spoke already about the obvious ones: life insurance, TPD, income protection, maybe trauma. But is that kind of anything that's still as important?
Trauma insurance is the most overlooked because I think largely most people don't know it exists. So the exposure people get to insurance is generally through their super fund. They'll get some default life and TPD cover, maybe some income protection. Trauma doesn't have a place in super. It doesn't fall under the legislation. Out of the $76 million of claims we've managed, half of them would be trauma related. And it's back to that, cancer, heart attack style of issue. How many people do you know that's been impacted by those?
Absolutely.
And the financial,
it's probably one of the most important in the world that we live in today and the issues that we're facing medically. It's probably one of the most important policies, right?
Yeah. Well, it has immediate impact. That's the biggest difference. So an income protection policy will replace your income after a waiting period, i.e. the amount of time you're off work before it pays you. So you've got to wait. TPD pays you a lump sum, but only when you can never work again. But if you have a cancer diagnosis happen today, the bills start racking up today. So you might have out-of-pocket costs for specialists and treatment and rehab. You still got mortgages to pay. You've got all these sorts of things. So having money show up when the event happens is incredibly powerful because it gives you choice. It gives you choice about the type of treatment you might get, how much time you have off work, whether you want to work or not, spending time with your family or having
affording
your family,
affording
a specialist or going for, experimental treatment overseas or whatever the case may be. So that's the most overlooked, but I don't think it's just because people don't really know it's there.
It exists. Yeah, it's very true. Very true.
Having managed so many of those claims, and even in my own family circumstance, I know what difference that would have made if money showed up to, make sure the mortgage is paid for a period of time, go and get the care that I want and all those sorts of things. It's hugely impactful.
So really, really important, listeners. If you haven't looked at that cover before or it's not been on your radar, please make sure that you speak to a professional and, check out a little bit more about the benefits that could provide you with as well. Now, Mac, we spoke a little bit about pricing and what can affect it, etc. What do you see the future direction of insurance premiums being? I know we don't have a crystal ball.
Yeah. I mean, the last 5-10 years have been quite profound, but there has been, significant systemic change that's gone on, which has caused that pricing. So, I'd like to think that we're entering into a period of stability in terms of the premium volatility. Like, they've made significant changes to income protection. There's changes coming to TPD cover. because of claims experience, I'd like to think we've reached the bottom of the advisor exodus. So the distribution channel is starting to improve in terms of placement of insurance. So I'd like to think that things should start stabilising. Some of the older back book products, like those older income protection policies that are no longer available, might still see some pricing changes because of the claims experience and the generosity of those policies. But on sale new products today, I think, are going to be more sustainably priced. So I'd like to think we're out the other side of a lot of the change that's gone on.
Yeah, absolutely. So, Mike, if there was one thing to leave our listeners with today, what should they go and do after listening to this episode? What is the one key thing?
I think it's as simple as just ask yourself the question: does the insurance portfolio I currently have align to my current circumstances? If something happened to me today, am I confident that me and my family would be financially okay? And if you've got any uncertainty about the answer to that question, go and get some advice about it.
Yeah, absolutely. That's a great one. Yeah. And something so simple that can easily be overlooked. And, it's a little bit like, people should have wills and enduring power of attorneys. It's always at the bottom of the list. Yeah,
it becomes very important when the events happen, but it's always the time when it's too late.
Exactly right. Yeah. So thank you very much for joining today on this podcast. We've also created another topic that we can speak about, so we'll definitely make sure that we cover off on that one. And we've got another couple coming in concession as well after this one. So listeners, if there's any feedback or any more questions that you have for Mark or myself in this area, please send them through. And we'll see you next time on the Wealth Experience podcast.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.